So today I'm going to cover intangibles for both managers and accountants. Especially, I thought it would be very useful for the managers to take this video as a guidance document uh, if they have to make a decision around what part of the development expenses can they capitalize and how to actually account for that in the balance sheet and the income statement is something the accountants could make use of by looking into this video. So let's get straight into it. The agenda is listed in here. I won't go over each and every item. You could just pause the video and read through the agenda. Let's head straight into the slide and talk about what are intangibles, right? So intangibles are something that are in the soft form, right? So we cannot touch them. For example, patents, companies, logo, brand, software, design. And this is as illustrated by IAS 38. So it's one of the standards, of international financial reporting standards. So, when understanding about intangibles, it is important to understand what are identifiable intangibles and what are non-identifiable intangibles. So, talking about identifiable intangibles, these are those intangibles that can be sold separately, right? For example, if you've got a software suite and from the group of the software, if you're able to separate one software tool, right? You've identified it separately. So, it's an identifiable intangible, right? When talking about non-identifiable intangibles, pretty much those that cannot be sold separately. Example, goodwill, right? So when a company A acquires another company B, then the difference of the what they paid the company B versus the net assets in the balance sheet of company B is equal to what goodwill is, right? So let's not get into the the complexity of like what goodwill is and how we'll calculate goodwill. Although I'll create a video on goodwill as well. But I think it's clear what's identifiable intangibles and what's non-identifiable intangibles, right? So you can't just say, for example, let's talk about goodwill a little bit more. That the branding for a particular company is say $500,000, right? You can't just separate it, right? Because it's so many things: the revenues, the market trends in terms of the equity and everything that contributes to the goodwill, right? So it's not just something that you could identify separately, right? Okay, so let's get into talking about internally versus externally generated intangibles. So when talking about internally generated intangible, it's as simple as it sounds. These are intangibles that are generated within the company by the designers or software developers of a company. For example, you could have designers generating a logo for yourself, a software, and the point to note about these internally generated intangibles is that the value or the dollar value, right, relating to these kind of intangibles is notional. What I mean by the term notional is that we are not able to measure them reliably, right? So for example, if you're creating, say, a company logo, right, and your company hasn't made, and for example, that's your startup and you haven't really made a lot of revenue just yet, but you think that the value of that company logo is say $50,000, and that is, you think, is the value for that logo. But that's not good enough for the accounting standards to be recognized as an asset, right? You need something that's more constructive to prove that, it is $50,000 that your company logo is worth, right? So that's the issue with the internally generated intangibles. That's why whenever an intangible is generated internally, more often than not, 90% or more, it is that you cannot recognize an intangible as an intangible asset. What it means is that you know, you'll have to expense it in the income statement. Now, talking about externally generated intangibles, right, which are generated outside the organization, the values of these intangibles could be measured reliably. Why? Because you've been invoiced for them, so you have like a physical or whatever soft copy of the invoice, and in that you have the value of the intangibles, or the value could be determined from the invoice, right, of those intangibles, right? So that's that. So moving on, now we've understood in the last slide what an externally generated versus an internally generated intangible is. Now let's see, if we've understood that it's an intangible, how do we recognize whether or not we can actually capitalize it? So capitalizing is nothing more than saying we have got the license to put it on the balance sheet, pretty much, right? So there are four key metrics that you need to commit to be able to recognize an intangible as an asset on the balance sheet. So you will not expense it, you will put it as an asset on the balance sheet, as a long-term asset actually. So the first thing that the entity has to show that it is probable that the intangible that you're creating, and let's take an example of a software license. So you have to show as an entity that it is probable that the future economic benefits will flow to the entity. The second thing that you'll have to prove is that the cost could be measured reliably. We've already talked about it before. That self-valuation by the firm for internally generated assets is not enough for a product or an intangible to be recognized as an intangible asset, right? You have to have something more substantive. The third item to prove is that there is control over the future economic benefits. So that is, to say that the intangible that you're using, you have like control over the future economic benefits that are being generated or that will be generated from the intangible, right? What it means is that as an entity, you'll have to prove that you have the right to use the asset and the right to direct the use of the asset in any manner, without the interference of any other party, right? So if you've entered into an agreement, right, then you'll have to prove, right, that there is no interference of the supplier, right? So pretty much you'll have to prove that your contract is a lease, or the part of the contract is a lease for yourself to be able to treat the intangible as an intangible asset, right? The other thing when talking about leases, I don't want to get into the leases aspect of intangibles, but you'll also have to see when you are probably when you have a contract with the vendor, say like of a software license, right? You will have to prove that the vendor cannot substitute another product during the course of the contract, right? This is a must to prove that the lease exists, and if you're able to prove that the lease exists, right, you are able to capitalize the costs, right? So that's why I have included the lease example in here, because a lot of managers get this question, and they are in a situation where they have like a vendor from whom they get the license to use over a specific period of time, and they have to determine whether they could capitalize some of the costs, right, to reduce the OpEx expense. The final thing, the final point that the entity has to prove that they are not internally generated. Again, if there are development costs, they could be treated as intangible assets. So it has an exception, right? So, and then the reason why most of the items or most of the intangibles are not that are internally generated are not treated as intangible assets is because it's difficult to measure reliably, or even once measured, it's difficult to prove the substantiation for that intangible. Yeah. So hopefully when you read these points, it will make more sense.